The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, so it is Friday, the 8th of August. Jeremy, welcome back. Good to have you here again.
Hi, Gareth. Yeah, good to be here.
So it's been yet another very interesting week. There's certainly been quite a few surprises. What would have been the highlights from your week in terms of where the macro data is taking us, what Trump's doing, and the reaction of the markets?
Well, last Friday saw the shoe drop in the US employment market as the non-farm payroll data came in with very large negative historic revisions. And that really set the cat among the pigeons, both in markets and in Washington, DC. It wasn't just that these data showed a slowing economy, hot on the heels of the previous day's hawkish FOMC press conference, which had led to a sharp reversal in short-term rate expectations. But it also led to a firestorm of criticism about the makeup of the labour market data and the functioning of the Bureau of Labour Statistics. And within a few hours, the head of the BLS had been sacked in what is now a common theme, now part of Trump policy. He didn't like the data, so he sacked the person responsible for them. I think it was Bismarck who said that policy making should be like a sausage factory. No one should see what goes on inside. But of course, the way Trump chooses to do things is to do it out in the open. And perhaps this is just a rehearsal for how he deals with Jay Powell, who he also continued to undermine this week. So everywhere we look, there is this sort of underlying fragmenting trust in the institutions that we've come to rely upon.
You're right. There's a sort of a shakiness that just shouldn't be there, I think. And I suppose that shakiness also transfers to the agreements on tariffs or the deals that people feel that they're striking on tariffs, because they seem to be chopping and changing as well. So where do you think we've got to with the tariff discussions?
Yeah, it seems like, as you say, we're a long way from the solid ground of what this new shape of any sort of emerging global trading system might look like. We all know he wants to change the way things were, but we haven't really got any certainty of the way things are going to be yet. And it has made me hark back to the good old days when the UK was negotiating its departure from the EU.
Oh, those good old days, yeah.
The myriad of detail and complexity, and the cry was always, until everything was agreed, nothing was agreed.
That's true, yeah.
Whereas these days, everything's agreed up front, subject to agreeing the detail later. What could possibly go wrong? Well, an example of that is Switzerland. One shouldn't laugh, but somehow neutral Switzerland, the country everyone has always seemed to accept is the most reliable, dependable adult in the room when it comes to geopolitics, but they've come out the bad guys.
They have.
How did that happen?
It is. It's very unpredictable. I think it's very dangerous in terms of companies and countries making their decisions. And it's extraordinary that the way Trump is exempting individual companies or individual very small niche markets from these deals. It's very granular and it's very fast changing.
We don't know what the granular stuff is yet, do we? Because we've had a trade deal with two of the largest trading blocs in the world, the US and the EU, that seemed to be agreed on the basis of a couple of sheets of A4 and a quick chat at the golf course. And now he's already saying that unless the EU is serious about however many hundreds of billions it is the EU has agreed to invest into the US economy, or whatever the deal is, that the rate's going to go up to 35%. So the detail is a long way from being settled here. So, I think it's very difficult to see clarity here, really.
So while all this tariff oscillation has been going on, what's been going on in the real world? Where have the world's big economies got to?
Well, the US economy is slowing down, according to the jobs data. But according to the PCE data, despite a slowing physical economy, the underlying core inflation pressures in the US and elsewhere are rising at the moment. And we're again being told this is temporary. They're choosing not to use the word transitory. So as I think Bloomberg pointed out Donald Trump has more obstacles to getting his lower rates than just Jay Powell. There are proper economic forces here. But just sort of bringing it back to the relationship with the Fed and what's going on in terms of policy making, intriguingly, there was an unexpected resignation of an FOMC member last week, which opened the door for a Trump appointee to take an early seat at the table. And overnight last night, we learned that actually Stephen Mirren, the chair of economic advisors and a well-known Fed critic, will take this post.
Okay, so the US economy feels like it's slowing on the jobs front. Inflationary pressures are still there. So what's going on with interest rates with all that going on?
Well, the short-term pressure is definitely down. Even with the added political pressure, the jobs data, given the dual mandate that the Fed has to target inflation and to protect the employment market, the short-term swings in the US rate market now is in full-on cut mode as the odds become pretty overwhelming for a US rate cut in September. But it's not that straightforward because term premia have extended, the curves have steepened. So bond investors are becoming more vigilant because inevitably, as a result of this, sovereign funding, particularly from the Fed and also in the UK, is just going to remain targeted at the short end, heightening these debasement fears, because the shorter term you fund things, the closer to monetizing your debt you become. And that has the risk of unanchoring inflation expectations. And that is the risk that's going on here. So we had Ray Dalio this week basically saying, select your real asset of choice, gold, silver, Bitcoin, fine wine, whatever it is. He said they should account for 10 to 15% of anybody's portfolio who's targeting long-term purchasing power preservation. Now, this is in contrast to the sort of global aggregate allocation of something like a tenth of that. So the pressure is on. And over the week, we've seen the dollar down, the oil price down, precious metals up, US stocks pretty positive, driven by a good results season, the pound up, and both US and UK 10-year yields lower, which is the forcing function basically of expectations of slowing economies.
Okay. And what about the UK? Because we've had our own interest rate conversation this week, haven't we? How did that go?
I mean, short-term rate moves in the US, basically it was a slam dunk for the Bank of England to cut rates at the meeting yesterday, and it duly reported what was widely expected, which was a 25 basis points cut. But like the Fed decision last week, it was complicated, and similar to the Fed, had the biggest split in the vote on the committee in sort of living memory. What we're seeing here is two groups of like-minded monetary policy makers disagreeing about how to respond to a world that's changing very quickly in front of them, and the impact that stubbornly high and growing fiscal deficits is having on the effectiveness of monetary policy. So the end of central bank independence and the undermining and potential rejection of arbitrary inflation targeting.
Yeah.
So I think, it's not surprising that people are beginning to focus on the price of gold and what other value yardsticks you use in a world where our monetary system seems to be going a little bit haywire.
Mm.
But in the real world, we're towards the latter end of the Q2 reporting season in the US and the sort of interim reporting season in the UK. One thing that jumped out at me is a report that someone had measured that 81% of S&P 500 companies reporting in Q2 have beaten expectations. Now, I haven't seen a comparable number for H1 in the UK other than that EY report that we discussed a couple of weeks ago that showed that the number of UK profit warnings, it is an all-time high. There does seem increasing evidence from the US stock market and earnings updates that maybe the sort of this so-called end of American exceptionalism has been a bit premature.
Yeah, the US stock market and the US economy has just been powering on and on, hasn't it? It's just extraordinary. No matter what anybody throws at it, it just continues to grow and continues to perform.
Yeah. What have you been looking at in the UK this week?
Well, yeah, it's interesting, actually. The one piece of news from the progressive client base pretty much makes exactly that point about the US economy versus the UK, because it's a very small business company called Sanderson Design Group, which is involved in luxury furnishings, wallpapers, fabrics, and paints. And this was a trading update for their first half to the end of July. So it's very sort of current data. What they're seeing is the UK market for them is still very difficult, lots of pressure, revenues being in decline. But in contrast, North America has been quite a lot better. They've actually seen growth there. They're also seeing some good performance in the licensing business. So overall, Sanderson, they've been through a pretty tough time, but they are starting to see signs of stabilization. They've also been cutting costs and trying to make the business overall a lot more resilient. So it feels like they're doing all the right things, and they're very much geared into a recovery. If there is any kind of upside or improvement across end markets, that will show through very, very strongly in terms of their own revenue and in particular profitability. So we'll see what happens across the second half for them. Any other companies around that caught your eye during the week?
Well, I think the standout, and I can't say I fully understand it, but the Smarter Web company, which we talked about in the context of these Bitcoin treasury companies, raised £21 million via a subscription from one US-based investor into what it described as an interest-free capital raising initiative structured as a convertible bond, but denominated in Bitcoin.
Okay.
The Smarter Web company, which did reach a valuation of £1 billion, is now capitalized at about half that figure from what I can see. So a lot lower than previously, but still quite a substantial premium to the value of the Bitcoin it carries on its balance sheet. But I haven't seen a Bitcoin-denominated bond, certainly not issued in the UK or anywhere else, as far as I'm aware. But
innovative, yeah.
Interesting and innovative and seemingly effortless way of raising £21 million, which understandably has its critics, but in terms of a potential transformation of capital market activity, worthy of note, if nothing else.
Okay. And what about next week? What's coming up on the macro horizon?
We've got UK unemployment data for June, which I think is going to be quite closely scrutinised next week due to the rises in national insurance and employment taxes last year, the impact that might have. Other than the COVID pandemic, last month's 4.7% unemployment rate is the highest this measure has been since 2017. So the pressure is on for Rachel Reeves and looks like that's going to continue to be so. We've got inflation data out of the US where the consensus is for an unchanged headline rate for July, but the core measure is expected to tick up to above 3%. So that whole thorny issue of slowing economy, rising underlying inflation pressure, how long can that sustain? Thursday next week, we get UK Q2 GDP data where the annualized figure will show a drop from Q1's 1.3% to something like half that figure.
Okay.
Clearly, UK economy is slowing at the moment. And on Friday, we get Chinese industrial production and retail sales data. And I think the market would take kindly if it indicated a growing and rising consumption patterns in China, which I think is all part and parcel of this sort of rebalancing of the world economy that is so desired by one Donald J. Trump.
That would help reduce the deficit, wouldn't it? Yeah. Rising consumption in China.
Yeah.
Okay.
And we also got the Michigan Consumer Sentiment Survey out next week. So another data point on how all this tariff uncertainty is reflected into US consumer confidence. We know that tariffs are attracting incremental revenue for the US. Trump has not been slow in telling us about that. But what we are less clear on is how that's reflected into confidence around the US consumer. So quite a lot going on next week. As ever, I think it's going to be ironing out the details of these trade deals and the changing pattern of these trade deals. That's going to be with us for some time.
Yeah, plenty of surprises yet to come, I'm sure. Yeah. So fantastic. That's all great. And we'll talk about next week's instalment this time on Friday. Talk to you then.
Okay, see you then.
Brought to you by Progressive Equity.